We're going to look at the Buffett buys you missed, JPMorgan's Mea Culpa, and then we're going to check to see if the keg is kicked on this bull market party. You're in the right place, folks, because this is where the money is. I'm Allison Southwick, and as always, I am joined by Matt Copenheffer and David Hansen. They are finance and banking analysts here at the Motley Fool, and we're going to take a look at all the big news from the day. So, as always, let's start with the headlines. First up, Wall Street Journal over there, Anuprita Das is reporting that Buffett is trading in his elephant gun for a slingshot, encouraging his managers to go after the smaller guys. So, Matt, what does this tell you about valuations right now? Is going small the right move here?
Well, valuations are a lot higher than they were, so I think it's a little bit more difficult for Buffett to find a good deal on a really large company. Although, with the Heinz deal, we saw that he's willing to pay up when the company's right. I don't think he couldn't get Heinz today at the same price that he did when he was part of the buyout. Berkshire didn't buy the entire thing. This is a story that our colleague Steve Symington has been on top of in terms of Berkshire and Buffett going after smaller quarry, we could say. 2.3 billion. Berkshire spent 2.3 billion last year making these small acquisitions, 26 of them for 2.3 billion. So those are pretty small acquisitions when we consider what a big acquisition means to Berkshire. Burlington Northern Santa Fe, of course, a few years ago, they got the Heinz acquisition. And then even the NV Energy acquisition, that was a Mid-American thing, but that was over $5 billion. So that's pretty darn big. What I like about these little acquisitions is that there is less risk for Berkshire in terms of them just being snap-ons. When you buy an entire company, spend billions upon billions of dollars, there's risk there. When you do a smaller acquisition bolted onto an already great company, that can work out a lot easier and very well. So this is a good way for Berkshire to deploy all that cash that it has sitting on its balance sheet. So I'm bullish on it.
So the article also pointed out that he's giving his managers more free rein and kind of being a little bit more hands-off. So does that make you worried, or are you fine? Do you trust his trust in his managers?
I definitely trust his trust. I think he's very selective in terms of what he buys, who he has managing the businesses. And when we think about it from why isn't he making big acquisitions, this shouldn't really be a surprise. He's owned and controlled Berkshire for such a long time. And if we think about it, not just acquisitions, but their insurance business, they've come out and said, when the prices aren't right, we're going to step away from the insurance business, and we're fine with that. And these can be long periods of time. This can be 5 years. It could be 5 years, potentially, before Warren Buffett makes a huge acquisition. And I think shareholders of Berkshire Hathaway, you have to be mindful of that and be comfortable with that there's not every year going to be a $25 billion acquisition. And you should be fine with that. You have the best capital allocator of all time, arguably, running your business. And if he doesn't think it's the right time to go make an acquisition, we shouldn't be pushing him and demanding, why aren't you making big acquisitions? I think you just have to sit back and really look at this as a long-term investment. You're not buying Berkshire for a 6-month holding period. You're buying this for 5, 10 years. Even after Buffett is one day no longer running the helm, you're still holding that in terms of those people in there making the right long-term decision. So I don't see this as a red flag that they're not making acquisitions.
All right, next up, we are going to the Financial Times. Tom Braithwaite and Kara Scannell, I'm sorry, Kara, are reporting JPMorgan is in talks to admit wrongdoing over the London whale losses. So we got a mea culpa here. We're going to hug it out. We're all good, right, Matt?
Yeah, not really. Not really. It's one of the unusual and interesting things here is that in a lot of the financial wrongdoing, a lot of the financial lawsuits, there hasn't been admission of wrongdoing. The banks have gone out of their way to pay money and not admit wrong in what they were doing. It's just, here's a bunch of money, leave us alone. In this case, it looks like JPMorgan may actually admit wrongdoing, but they want to keep it off their upper level managers, especially, obviously, Jamie Dimon. So essentially, the bank is going to say, yeah, we did wrong. We didn't have great oversight. We didn't disclose that properly. But don't blame it on our top people. So, I mean, that's a little iffy there. But here's the thing. The London whale, I'm over it. Obviously not. It's an easy story to cover, right? And it's an eye-grabbing story, and everybody still hates the banks. We're going to talk about that a little bit more in a few more minutes. But here's what I like. This is what Jamie Dimon said earlier this year. He said, "I don't know what more I can say. Bad strategy, badly vetted, badly monitored, badly controlled, embarrassing, terrible, sorry." What more can you say?
Yeah, I mean, I think it's almost a good thing potentially for shareholders today. I think when news like the London Whale and even the stuff around Diamond potentially stepping down as chairman, all that noise, we didn't see it really pound the stock price down, but I think it is still an overhang in terms of some investors buying into the JPMorgan culture, buying into that stock for the long term. So I still see this as an overhang, and why this is, in my opinion, a good stock to buy today for the long haul. I think this stuff in 5 years, we are not going to be talking about the London Whale. I can almost guarantee you in 5 years, go through the transcript of the conference call, you're not going to hear London Whale. This is going to blow over. It's a hiccup. It doesn't look good, but I think it is providing some overhang and some opportunity for investors that are willing to deal with these headlines.
All right. So next up, we've got Reuters. This is Ryan Vlastelica. Oh, just Twitter us if I'm butchering your name.
To be fair, my last name is Copenheffer, so...
I've been trying to say Copenheffer.
No, you've got it right. I'm just saying, if somebody was trying to read my name, it would be probably pretty badly butchered. So I think we're doing pretty well overall.
All right. So we'll go back to the Reuters story here. Ryan at Reuters. Wall Street, little change, on track for weekly decline. So the story here is that we've seen the worst week since, Are you ready? The worst week, you're getting nervous, since June.
Oh my God.
I know. We're not alarmists here at the Motley Fool, but I assume, David, that you are stockpiling your bomb shelter right now.
Not quite. I wouldn't even known that it was the worst week. We don't look at the worst week
since June.
In June, it's whatever. I know Matt has said that he's actually rooting for the market to go down, and that's not a unpopular opinion. I don't think. When you go back to Ben Graham's Intelligent Investor, I think in the most recent one with updated commentary, they're saying you should root for the market to go down if you're a long-term investor, because that gives you opportunity to buy more at lower prices. So when I'm looking at the market today, are there some stocks that look a little bit overvalued? Yes. I can say that with confidence. In my opinion, yes. Are there some that look undervalued? Yes. So I think you just have to look at the individual stocks here, and if you hold one that's had a great run and is potentially overvalued, maybe you trim it back and buy one of the stocks that you think is undervalued. I don't think the market as a whole is vastly overvalued and you can't make money in the stock market anymore. I don't think that's the case. So I think you just have to look at it by stock basis right now.
Worst week since June.
Do you remember
June, David? How are you not panicking
We were so
here?
happy back then. Days of wine and roses.
We had no idea what was ahead, and now look at where we are. It's August, and I love these stories. It's like, oh, stocks just had their worst half hour since yesterday between 11:45 and 12:15. It's terrible. The S&P is up 21% year over year. As of when I checked it this morning, for this week, the S&P 500 was down 1% for this week. This is not something to panic about. In fact, I'm panicking a little bit that it didn't fall more. As David said, I am rooting for this. I want stocks to get a little bit cheaper. I want to do some buying, and I'd love to see them get cheaper. According to the data that Robert Shiller keeps, he looks at a 10-year average PE ratio. That ratio, compared to history, is starting to look a little bit high, a little bit above the average, which isn't ideal. The 1-year PE, the 1-year price to earnings ratio, is at about 18.5. That's starting to get a little bit above average. But the other part of that is that we rarely see stocks actually valued at their average. We go through these periods of they swing way up past the average valuation, they swing back down below the average valuation. So I'm not worrying about this, except to the extent that I'd like to see stocks cheaper. In the meantime, I'm busy reading 10Ks and reading conference calls and watching earnings reports and learning about the companies that I want to own as opposed to worrying about what is the time period that I can compare this one to so I can say the worst or the best. Maybe next week will be the best since mid-July. That's my prediction. I'm gonna put that down. Next week is going to be the best week for stocks since mid-July. How do you like that?
Yeah. All right. So now it's time for our deep dive. David, you were reading Pzena Investment Management. They manage about $20 billion. You were reading their second quarter 2013 commentary, like most of us were in our evening, just perusing it. Why not? And you stumbled across a little quote that got you thinking about recency bias, which is a little something that can trip investors up. So if we can pull up the quote, "The financial sector is a prime example of stubbornly strong disaster myopia among investors." So, David, talk to us a little bit about this.
I think it hit right on, in my opinion. Again, my opinion. I think when we think about the financial sector, it has had a good ride. I think it's outpacing the S&P, which is up over 20%, like you just said. So some people might be looking at the financial sector and say, "Oh, it's back. I missed the boat on the financial sector." I don't think that's true. I think there's still a lot of distaste related to the most recent financial crisis. I think that's really holding a lot of financial companies and stocks back. Earlier in the week, we were talking to Morgan Housel about recency bias, and people like to look at the last thing and assume the next thing is going to be just like it. So when we think about crisis, people look at the last crisis and say, well, the next crisis is going to be all driven by the banks because the last one was. And it's going to be just as bad. Unemployment is going to be just as bad as the last one. And almost every single time, that is not the case. So I think that is still lingering 5 years later. People are just not comfortable holding these financial stocks, and the cycle could turn, and these could be very profitable institutions, great for shareholders. I think that recency bias from a negative perspective may have people missing some opportunities in the financial space. What do you think, Matt?
I like it. I agree. What can I say? I mean, this is kind of the story that I've been trying to tell over the past few years. And I think investors are missing out, particularly today. We were just talking about how strong the market has been performing and how valuations are starting to creep up to look at least fair, if not a little bit rich. But yet I look out over the financial sector and I see a lot of companies, a lot of stocks that are still selling at valuations that I think are very attractive and are going to produce very attractive returns over the next couple or 5 years. Yesterday, I wrote an article. I actually looked back into the full archives. And Whitney Tilson, who's a successful fund manager, he based his fund after the investing wisdom of Warren Buffett, used to be a writer for over here at the Motley Fool. And he was writing back in 2000 when everybody was crazy about stocks and valuations were totally insane. He was writing about how valuation matters. And one of the things that he said in terms of how to think about valuation is not thinking in terms of one number. At 20 times PE, a stock is not overvalued or undervalued. But rather the way he looked at it is when he looks at a valuation and thinks to himself, I can't believe I can buy this company at this valuation right now. And when I look at a lot of the stocks in the financial industry, or at least some stocks in the financial industry, I think about like JPMorgan, I think about AIG, I even think about Berkshire Hathaway, quite frankly, particularly when you start comparing it to a lot of, I know you're laughing at me.
Because everything makes me think of Berkshire Hathaway.
Everything
you
does.
eat a bagel in the morning and you're like, oh, that reminds me about Berkshire Hathaway.
I had a bagel at the Berkshire Hathaway annual meeting, so there you go. But I look at stocks like that, I look at their valuations today, and particularly in comparison to the rest of the market, I'm thinking, I can't believe I can buy these at these valuations right now. What I will say, however, as long as we're talking about behavioral biases, there is another bias called confirmation bias. And what I love about this theme that we're talking about here is that it's exactly what I've been thinking about over the past few years, and it's exactly the way that I've been investing. However, there have been some changes that could impact how profitable these banks are going to be. You look at the regulatory environment in particular. That could crimp the amount of profits that some banks are going to make. AIG, although it's recovered, it's focusing back on its core business, the company has changed. And so its future may not look totally like its past. And in addition, when we're thinking about the banking sector in particular, the way the banking sector has been structured and organized has changed so much over the last 30 years, the last 40, 50 years. It's an industry that's gone under more change than I think most other industries, except maybe technology, in terms of how it's structured and regulated. And we had a long stretch where it was pretty lax regulation, and that may be tightening back down now, and that could impact all of this. And we can look back and say, okay, maybe it wasn't those stocks weren't as stupid cheap as they looked back then because of the changes. But for now, I'm still very bullish. And I agree. I think that there is a lot of recency bias at play here, and I think that's leaving open some really good valuations.
Yeah, one of the quotes from Whitney Tilson's article, I think, it was like, the laws of valuation gravity have been temporarily suspended, but in the end, value still matters. I think that is very important right now. Just to go back to what I said earlier in the show, is that there are some stocks that do look overvalued. So I think it's really you have to look at the trade-off in terms of, what's the market? Say you have, all right, I'll use a real life example for myself. We'll make it a little more personal. I'm a shareholder of Zillow, as we talked about, up over 250%. When I purchased the stock, I was not anticipating that type of run. And it's easy to look at that and say, I'm a genius. I picked Zillow and it's up 250%. This is exactly what I thought it was going to do over the course of 10 months. Full disclosure, I did not admit that. So when I see the market giving me that type of price for a company that hasn't really proved itself, but could definitely prove itself in the long run, could certainly be a successful company and a successful stock. But I look at that at those levels and say, should I sell that and buy a company like Berkshire Hathaway that, in my opinion, is perhaps more of value right now for a long-term investor? So I think that's kind of the trade-off you have to make and ask yourself, is the market giving me such a ridiculous price that I can turn around and buy something that I think over the long haul gives me a better risk reward for the next 5 to 10 years.
Yeah. All right. Well, I think that covers it for our deep dive. Now it's time for a little game we call Investing Chicken. This is where I get to sit back, and in this case, David is going to be buying Annaly, or you're looking at Annaly.
He owns it.
You own Annaly.
He is a shareholder.
You are a shareholder, and Matt here is going to throw some scenarios at you to find out when you would actually sell Annaly, when you're going to swerve off the road, playing chicken here essentially. So I get to stand back and let you guys.
I'm going to turn you into a weepy.
Bring it on.
A weepy pile on the side of the desk here, and we'll start off easy.
Okay.
Annaly cuts its dividend 20%.
No, absolutely not selling. I've even said I would almost encourage it in certain scenarios that they're cutting that dividend in defense for longer term strength. So not even blinking an eye.
Okay. Annaly's stock goes up 25%.
Up 25% would get it, I believe that would get it above book value. But for a company that double-digit dividend and over the long haul, I think can produce double-digit returns on equity, I think that's still a fair price.
Okay. The economy gets cloudy and the Fed increases mortgage-backed security buying.
That would be, I think that would, I would consider it a little more, because we saw yesterday Annaly reported earnings, and in their conference call they said, we're scaling back our leverage, we are waiting for higher rates. And if something like that happened, that just was really going to push down rates for the long haul and basically hurt that company. I could potentially start to look elsewhere if there was better value, but I don't think that's really pushing me off the road. I'd be on watch if that happened.
Okay. Annaly has already bought sister company Crexus. What if it also bought Chimera?
Ooh. I think it would depend on how much they anticipate that becoming part of their business. We talked about Crexus yesterday, the commercial real estate, riskier than these agency mortgage-backed securities that are backed by Freddie and Fannie. They're keeping the commercial business very small in terms of their overall portfolio. If they increase that and brought over Chimera and that made up 25%, I would be I could be selling at that point, potentially. What's your last scenario? And
I've got two more.
Two more. Okay, keep them coming.
I'm going to bring it. I'm bringing it today.
That would be a cause of concern, just because they've been known for so long as just a strong balance sheet, having mostly agency mortgage-backed securities, not really having to worry about that default. So when you bring in the riskier commercial real estate holdings, and Chimera, which longtime investors or people interested in that stock have known, they've had some issues in terms of accounting.
You're sweating.
Yeah, it would be interesting.
Fannie Mae and Freddie Mac, we heard from President Obama. We've got a plan out there from Corker and Warner that are around winding down Fannie Mae and Freddie Mac. Annaly depends on them for the agency-backed market. A plan is passed to wind down Fannie Mae and Freddie Mac. It's going to happen over the course of 3 years.
So with the Corker-Warner bill, the government is still at the end of the road there, behind private capital. Is that's
sure.
the case?
Let's say it's the Corker-Warner bill, but the timeline is 3 years Fannie Mae and Freddie Mac are gone.
I think that wouldn't impact me at all, because if the government is still there at the end of the road, ensuring that liquidity in the market, I think those securities are still safe.
Okay, here's the one. Here's the one. I guarantee this one will get you. Wellington Denahan unexpectedly leaves Annaly.
That could potentially.
Potentially.
I think. Okay. I'll give you a definite answer. I think I would strongly consider selling it at that point, because when we look at the mortgage REIT space, there's been a huge influx of mortgage REITs and people creating their own mortgage REIT the last couple of years. It's been a great couple of years. Wellington Denahan, she's been in the business for 20 years, and if you listen to her on conference calls, she understands the business. Some of these other management teams, it's a little iffy because they're new to the space. So depending on who would replace her, if they just brought in someone completely new out of their culture, I think that could potentially drive me to sell. The other one that you didn't mention is if this would make me sell.
Okay. All right, we want to hear it.
If the bill floating around the House from Jeb Hensarling, who aims to completely take away the government's involvement in the mortgage-backed security market, and those were no longer guaranteed, I would sell at that point, because you have a fund that relies on short-term financing using basically unsecured and not default-free securities anymore if the government wasn't involved. And if you have a credit crisis like we had in 2008, those credit markets can dry up very fast, and the company can be here one day and the next day not be there. So if that was the case, I would no longer be.
Well, I tried. I got pretty close.
So there you go.
I had you sweating there.
And just a side note, I think that's very unlikely. I don't think Annaly shareholders need to worry about that bill passing. It's a nice bill in theory to take the government out of things, but it's just not very likely in my opinion. So I don't think that's something to worry about today.
All right. So it looks like he won that one.
Yeah.
Right? That's okay. There'll be more tomorrow. All right. So now it's time for a look back. It's Friday. Basically, a few things happened, but I want to know, Matt, what is really standing to you as a big event from this week?
Charles Evans, Fed president over in the Chicago branch of the Fed, the Chicago Fed Bank, said that it's quite likely that the Fed will slow down the $85 billion bond buying program sometime this year. He basically thinks that the economy is better than people think. And this kind of continues that conundrum of the good news, bad news cycle, that good news can be bad news, that the better economy may lead the Fed to taper. A lot of people take that as bad news, that's less accommodation for the economy. I think I'm going to go out on a limb here, right now. I'm going to say that good news is good news. If the economy is better than we think it actually is, I'm sticking with that as good news. I'm ignoring all of this taper tantrum baloney.
Despite what our colleague Morgan Housel said earlier in the week, actually when the Fed has tapered previous programs, interest rates have actually gone down, because it's kind of a signal of, oh, they're tapering, that's going to hurt the economy, so people can move back into treasuries, even despite that.
I'm not contradicting Morgan. I'm just saying that I'm going to be happy about a
As a
better
long-term
economy.
investor, good news is good news.
Good news is good news.
Cool.
And I feel like I have to go out on a limb for that. That's pretty sad.
Yeah.
All right, David, what stood out to you this week?
We just talked about it in the last segment, but going to go back to Annaly Capital. They were one of the last mortgage REITs to report earnings. It was a rough quarter for all the mortgage REITs before they reported earnings, with interest rates going up. And I was pleased with what I saw as an Annaly shareholder. They're being very defensive in this environment, which I think is a good thing. They've scaled back their leverage, which is something that you want to do when you don't think it's a great time to be buying the securities that they hold on their book. So I was encouraged by what I heard from them. It'll still be interesting going forward with the Fed still in the market. But I think if you're holding Annaly today, I think that was a vote of confidence yesterday that they came out. And I think if you're on board with their plan, you can still succeed over the long haul.
Yeah, and actually Markel also reported earnings this week.
That's right. We can't overlook
we can't
Markel.
forget Markel.
Markel, often known as the baby Berkshire because it's run kind of modeled after Berkshire Hathaway's model. Net income at Berkshire and Markel was down big year over year. This was due to a pretty hefty underwriting loss. They're also integrating Altera, which was the reinsurer that they just purchased, sort of merged with. It was a very large purchase. So there were charges associated with integrating Altera. Altera had a very big underwriting loss, which is kind of interesting because Markel is known for reserving against losses to a very great degree, and then in future years saying, "Oh, we over-reserved, so we'll put that back in profit." So with them bringing Altera on board and seeing such a big underwriting loss from them right out of the gate, I'm kind of thinking that maybe they're over-reserving here for Altera just to make sure that everything's going right and that they have the cushion that they need from an underwriting segment that they're not totally used to, that they're just bringing into the company. So optically, the quarter looked pretty bad, but I think everything is on track for Markel, and I think investors can be very confident in the future.
Yeah, I think when you look at Markel, it's one of those companies that quarterly reports basically don't even matter in the long haul. This is not a stock that you buy to get rich fast by any means. This is a very long-term story that's going to just slowly grow book value and compound. So don't buy this today thinking, oh, Markel's 50% upside by the end of 2013. That's not the case here, but this is a great management team, great run company that's positioned for the long term.
On that note, I'll say pick up the annual report when it comes out. It's actually a great read. I mean, it is actually a great read. Pick that up when it comes out. Evaluate Markel on that basis, not the quarterly reports.
All right. Now it's time to head to the Twitters like we do every day. If you are not already, you can follow us at TMF Financials. That's two F's right there in the middle, TMFF. And financials.
Yeah,
whatever.
enough.
It's Friday. I'm going to get a little punchy here. So first up, we're going to Business Insider, at Business Insider. All caps. Mark Faber, a 1987 style crash is coming. Dun, dun, dun. So Matt, how much should I be freaking out here?
Well, I had water when we started, and I'm now out of water. So my glass isn't just half empty, it is wholly empty. And Mark Faber's glass is totally empty, but it always is. What's interesting, and credit to Morgan Housel, who pointed this out to me, last May on Zero Hedge, there was a blog post. Essentially, Heather, can you put that up on the screen? There's a blog post that essentially said the same thing. And we've had such an incredible run in the stock market between then and now. I'm not freaking out. That's pretty much the bottom line there.
Yeah.
These predictions are ridiculous. You talked about Morgan. That's like his crusade against predictions. There's these people out there that they make these predictions every year. And there's a recession every 7 years or some 8 years. So eventually, if they keep saying it, they're probably going to be right, and then they can say, "Hey, look, I called this." But it's great to hold people accountable and say, "Hey, you called this last year, and the S&P is up 25%. So just
it's still coming.
Be cautious.
At least he's recycling.
Right. I mean, just be cautious.
All right. So next up, we've got from David. Shawell. Do we know him? We don't know.
Say Schwell.
We just follow him on Twitter. David, you said fall in 2Q book value for REITs versus leverage. Leverage hurts when the party ends. This is such a sad day. Everyone is so pessimistic. Right?
Yeah, and
the market had the worst week since June. We should be pessimistic. The worst week since June. Sorry, go ahead.
So he's talking about the mortgage REITs, these levered funds that invest in mortgage-backed securities, and he linked out to a Twitter picture that we have up there, basically saying how much was each firm levered and how much did their book value fall in the first quarter. And just a couple of things to note on this. You see a company like Two Harbors. Okay, they didn't fall that much, and they didn't have a lot of leverage. That's due to a couple of reasons. One, they weren't that leveraged, and two, part of their book is in non-agency mortgage-backed securities. So if we go back once again,
They're also really smart.
to Annaly Capital, they brought on their commercial real estate investments, and they said, we're not going to lever those. So we're not going to use borrowed money to fund those investments, since they're already more risky in nature than an agency mortgage-backed security. So Two Harbors, they have these non-agencies. They don't lever them as much, so that's why you see that leverage ratio not quite as high. On the other side of the spectrum, you have on that graph American Capital Agency, who's that green triangle there. They invest almost entirely in agency mortgage-backed securities, so they use a higher leverage, and you see the fall in book value. Same with a company like Western Asset Mortgage. All the way down there, almost exclusively agency mortgage-backed securities. You have to use more leverage in order to get more income off those securities, since they yield so little. So anyone out there who's interested in these mortgage REITs, don't paint them with all the same brush. Look into each of these mortgage REITs and find out how they're positioning, how much leverage do they have. If they're not using a lot of leverage, do they have riskier assets on their books that are potentially non-agency RMBS, commercial real estate investments? So really look at that portfolio, understand what you're investing in, see where the risk is, because as you can see from that graph, there's a lot of variability in terms of how much these things can change when interest rates change based on this leverage and what they hold.
I'm just going to jump in for one quick second. In terms of the leverage, when you're talking about that and you're talking about using it on agency-backed securities, the economics of this business kind of stink right now if you're in agency-backed securities and you're not leveraging. If you look at Annaly, their leverage is about 6 times. The spread that they're getting between what they're earning on their assets and what they're paying on their funding is about 1%. So 6 times leverage, 1%. The returns that you're getting there are not good, and they're terrible if you're used to normalized mortgage REIT earnings. So when you think about levering it up, it's pretty attractive to do that right now because you can jack up your returns. But if the management team isn't confident in what they expect going forward, as Annaly has said, because the Fed is in there doing all of its black magic, it's probably a better time to accept those lower returns and be safer with lower leverage.
Yep.
All right, last tweet we've got from Chris Taylor. Thank you, Chris Taylor at Reuters, for having a name I can pronounce without any concern, at Chris Taylor _NYC. First jobs of finance gurus, my new piece for at Reuters Money. Basically what he did is he wrote an article here about a few guys in finance and what they did back when they used to put their pants on one leg at a time. So as we know, Warren Buffett used to be a newspaper boy. Some other guys used to shine shoes and other weird little antiquated jobs like that. So I want to know what your guys' first job was. Who wants to go first?
Go for it.
My first job was programming databases. That was, yeah, well, come on. But after that, I did that for a while. And then when I was in college, actually, I spent some time doing high-rise caulking and serving pizzas at an Italian restaurant. So.
Yeah, we all have to pay our dues waiting tables. All right, how about you, Dave? What was your first job?
I was really bad at it too, by the way.
I made bagel sandwiches, and they weren't just your standard bagel sandwiches. They were put in one of those steamers, if you've ever seen something like that. So there's water underneath, you put the bagel in, push down on a lever, and steam comes up. So it melts the cheese and all that stuff.
Just gets it all together.
Is it good?
Yep. Yeah, it's good.
It's not soggy.
It's not soggy, no. It makes it nice and moist.
We're gonna get one of these.
Yeah.
It's called Owen's Bagel and Deli in Charlotte, North Carolina. So if you're ever down there, look it up. It's quite tasty.
Take a road trip.
Right, road trip. You could probably make an excuse, go down to Charlotte.
Like right now.
Bank of America's down there. We can do some interviews
things.
at the same time.
Right now, we need to get in the car and go get a bagel sandwich.
Right. Sounds good. All right, guys. Well, I think that covers it not only for today, but also for this week.
Yep.
So we will see you again on Monday, because this is where the money is.